Good morning, everyone. You're watching the live market outlook for Monday, 14th of November 2011, prepared by Windsor Brokers. Some positive tone came back to the markets after a temporary solution found in Greece and Italy, the burning problems of the European Union, as the new governments have been appointed. And now technocrat leaders in Italy and Greece are rushing to, actually they're still forming the governments, and they will face a critical test of their ability to limit the recent damage from the Eurozone debt crisis when financial markets start today. Actually, it's their day today to start. Italy's president asked former European Commissioner Mario Monti yesterday to form a government and restore the market confidence in an economy whose debt burden is too big for the Eurobloc to bail out. So Italy should, at this point, more depend on their own things than to await help from the Eurozone, as the Italian debt, just to remind you, is around 1,900 billion euros. And Italy is the third biggest economy in the Eurozone, so the crash of Italy would be definitely signaling the end of the Eurobloc. The investors will pass initial judgment on his leadership when Italy's treasury is asked investors on Monday to bid for up to 3 million euros in the 5-year government bonds. At an auction last week, the government borrowing costs surged above 6% and kept rising to levels well beyond what the country could afford to pay over the longer term. And the stocks and the euro are higher this morning on hopes that Monti and Greece's new Prime Minister Lucas Papadimos would take some decisive action. As I said, some positive sentiment is seen in the markets as euro is regaining ground and is back to the levels of the previous range, around 138, but still remains vulnerable at the upside as 138.50 zone. The also Fibonacci level is capping the upside. We will come to this point later in the technical part. Also significant is the steadiness of crude oil that approached our $100 per barrel level that I mentioned in our past few sessions. That was the main target. 99.66 was seen overnight after the opening, and the crude oil remains steady for now, as well as gold that actually broke briefly above 1800 previous week, and then corrected as low as 1735, but fresh strength is now underway, and the 1795 was seen so far, keeping the yellow metal steady and looking for a further extension higher. As I mentioned, the equities and commodities were significantly higher during the overnight session, as the Italy and Greece are now rushing to form the government, and the governments and start working on working on this the main task for them in order to handle the current crisis and prevent the worst scenario, which would be the bankruptcy and the possible crash of the European Union. From today's events, actually these were the main events, main market drivers overnight, and looking for today, as the calendar is quite poor today, and the only few events are due to be released today. Actually, we had the preliminary GDP in Japan already released. Quarterly one came as expected at 1.5%, while revised industrial production monthly in Japan, also released earlier this morning, came slightly better at minus 3.3% compared to the minus 3.8 forecast, and the negative 4% in the previous month release. So some more positive tone coming from Japan. Due today in a couple of minutes, Swiss PPI monthly forecast for today is minus 0.3% compared to minus 0.1% previous month release, and the Eurozone industrial production due at 10 GMT, monthly decline of minus 2.1 is forecasted for today compared to 1.6 growth in the previous month. So more negative news are expected to come from the Eurozone today regarding the economic indicators of industrial production. Let's take a look now on the charts, see the latest price action of majors and the commodities. We are in euro. As we can see, the euro, after heavy losses suffered last week and breaking below 139.55 and 136.55 and 136.07, the previous low, extended losses below psychological 135 level to find temporary support at 134.83. The recent strong rally regained 138 handle. 138.10 was seen on opening this morning in the Asian session. However, this is still posing strong barrier for the pair as 138.50 part of the previous range ceiling, as well as 50% Fibonacci retracement of the down move from 142.46 down to 134.83 is still acting as a strong barrier at this point, and we need to see break here to signal bottoming at 134.83 and resume gains. On the upside, break of 138.50 opens round figure at 139.00 and then 139.53, which is the Fibonacci 61.8% retracement of the previously mentioned down move. On the downside, the current range floor at 137.40 has been briefly dented as the pair dropped to 137.29, and the break here, actually we are losing also the 20 days moving average on the hourly chart, so it might trigger fresh weakness and look for a test of 137 and possible extension to 136.55, which is the previous strong support zone, and also the high of 10th of November. So the loss of 137.40, 137 would be signaling fresh weakness and the possible test of 136.55. And on the upside, the lift above overnight's high at 138.10 opens strong resistance at 138.50. The 4-hour studies are emerging above the negative, above their midlines, coming out of the negative zone. However, conditions RSI close to overbought zone is putting pressure at the upside. On the hourly chart, positive studies are now fading a bit as the MACD breaks below the signal line, but still holds above the midline. And the current loss of 20 days moving average, in case of clear break, would weaken the near-term tone. For now, the immediate action is seen still towards the upside as the pair attempts to hold above the recent 137.40 range floor, and the focus is still at the upside, 138, 138.10, ahead of 138.50 strong resistance. The British pound remains within the recent range as the downside strong support zone at 158, 159, 158.75 so far contained dips despite the brief break below to 158.67 seen last Thursday. However, the strong rally reached 160.92, just short of 161, which was our initial target, and then we have 161.30 and 161.40 the high of 8th of November and 200 days simple moving average on the daily chart that actually limits the upside in the short-term period of time. Clearance of actually these levels should be closely monitored as clearance above first 161, then 161.40 and 161.64 is required to signal the resumption of the broader uptrend from 152.71 low of 6th of October. Failure to clear above these levels would keep the pair within this range, and on the downside we have the main supports again at 159, 158.70 now, below which would be bearish and would signal some stronger reversal and correction of the 152.71 to 161.64 ascent, and look for next levels at 158.50, which is a strong support, also previous consolidation ceiling, and then we have Fibonacci 38.2% at 157.80. So basically the sterling dollar, we have to watch the extreme levels of the recent range. Break of either side would define the further direction. However, the outlook is still more focused to the upside, and the 161 is our next target in case of holding above 160, which is key psychological support, and then 159.85, the previous high. Dollar yen is firmly in the bear trend after losing 78.0077.75 initial support of the post-intervention pullback that attempted to stabilize above 78. However, further bear pressure pushed the pair lower, currently testing 77 level, which is the key support, as it's close to 61.8 Fibonacci retracement of the whole 75, 56, 79, 52 post-intervention rally, and also it's a previous August to October range ceiling. So loss of 77 level would signal pair losing all the effect of the intervention and returning back to the past nearly 3 months range. With still pending the possible intervention from Bank of Japan. However, we set some critical levels that might be triggers for the intervention, which was 77.75 and 77.50. If you remember, in past a few days ago in the session, I mentioned these levels. However, the Bank of Japan is still not reacting. We'll see. This is still pending, so we should consider this as a serious option. The further intervention, as they did manage to stabilize the Japanese yen, and it's again back to strength. Also, we have strong support on 76.95, which is daily 55 days moving average, below which definitely would be turning down to the range and losing all effects of the intervention. Dollar Swiss is near term at the back foot after a recent strong rally, short-term rally from 85.66 end of October high, peaked at 91.47 on last Thursday, and currently it's in the third wave of the correction. Important to mention at this point, 89.50 is the strong support where the pair currently is attempting to base. This is also the previous high of 1st of November. And basing ability to build the base here would signal fresh strength and a possible revisit of the levels. First comes 90, which is closed now, and then we have 90.72 and 90.88, the previous highs, ahead of 91.00 and then 91.47. Studies are still, 4-hour studies are still in a way positive. However, the 20 days moving average is still pointing higher, but the price is below it. So this is putting additional pressure on the pair. Break above this one, which is currently at 90.39, would signal some fresh strength and possible revisit of the previously mentioned levels. On the downside, loss of 89.50 and 89.20, which is also the Fibonacci level of 38.2 of the entire move from 85.66 up to 91.47, would weaken the short-term tone and possibly open way for a further reversal and put the short-term bulls on hold. There is also sort of head and shoulders pattern that looks like head and shoulders pattern at this point, and also 89.20 50 zone seems to be the neckline, so loss of these levels would be very bearish in the near term. We are in the gold. As we can see, the daily outlook on the Ichimoku studies shows the strong uptrend as the price holds well above the daily cloud, keeping the positive tone in play. On the near term, the gold ended the correction at 1735 on the last Thursday, and the fresh strength is now underway. As I mentioned earlier, 1795 was reached so far ahead of previous high at 1892. The near-term structure remains positive and supportive as the pair now attempts to hold above hourly 20 days moving average, the initial support level ahead of previous lower high at 1775. So holding above 1780, 1775 would keep immediate positive tone in play, and above 1800 to open levels at 1828 and then 1844 on the break. On the downside, 1735 is the main support, where also the 255 days daily moving average stands, and the 20 days is now approaching, has already crossed above 90 days. Cross of above 55 days moving average would give another positive signal and signal the resumption of the short-term uptrend from the 1532 low of 26th of September. The crude oil is, as I mentioned, well supported for now, as the positive signals from Eurozone have raised the initial fears, especially also the positive news that came last week from China have minimized actually the fears of possible reduce of the world demand for energies, and the crude oil price is now moving higher, approaching our main target at $100. Currently tested the 61.8 Fibonacci retracement of the broader downtrend from 114.80, the 2nd of May high, down to 74.94, 4th of October low, above which opens next level at 100.60 and then 103.30. The 200 days moving average on the daily chart at 95.29 underpins currently the gains, and the focus is at 100, our initial target. The corrective action at this point should find the initial support at 98 zone, which is actually it's a strong support, while a loss of 97.30 would be a bit risky and might signal deeper correction. The near-term outlook for crude oil remains positive, while holding above 97.30, which is also the 20 days moving average on the 4-hour chart.